Welcome to our discussion of the brand new forms the IRS has released to implement the new additional taxes that our clients are going to face this year on the Medicare taxes, meaning the additional 0.9% withholding on wages and self-employment income, as well as the Section 1411 net investment income tax. In August, the IRS released drafts of the new Form 8959, on which we will compute the additional withholding tax, and the new Form 8960, where the Section 1411 net investment income tax will be reported. The Form 1040, released back in July, the draft version, showed a new line entry for line 60, where we're going to put the results of these two forms. As we'll also discuss, we're going to modify our reporting of federal withholding tax on the Form 1040. We're going to modify that because we're going to have to compute how much additional withholding we're going to pick up due to the additional Medicare tax withholding. The Form 8959 is shown on your screen. Now, probably not a very readable form for you, but we're going to break it down and look at its 5 parts. Part 1 deals with standard W-2 wages. These are wages not from the railroad, not covered by Railroad Retirement Act, and obviously not self-employment. Probably for the largest number of taxpayers, these 7 lines are going to be the key. You pick up Medicare wages on this form, as well as any additional Medicare wages that would come from the 4137 or 8919 if you have some items that were paid to you and not reported as wages. You add those 3 up, and you compute based on the limitation. As the screen shows, we're looking on this for, if you're a married couple, we're looking at it jointly. If you're married and you don't file joint with your spouse, you're going to get a lower limitation, and if you're single, you get another one. Now, this is interesting because your wage withholding is going to be based solely on whether you're paid more than $200,000 from a single employer during the year. So, the first hint you have to have is the withholding will be wrong in many, if not most, cases. For a married couple filing a joint return, we're going to look at combined wages, Medicare wages from both spouses, of $250,000. If they're filing separate returns, each spouse has $125,000, which they're going to use on this form. For all others, that is the unmarried, we're going to have $200,000 to work with here. Yes, that is another marriage penalty. On line 6, if your wages don't exceed that level, you don't pay any of this tax and you're done, at least unless you have self-employment income. If you do exceed that number, we compute the additional Medicare tax on wages on line 7. And you hold that for a while because we have to check if we owe any on self-employment income or Railroad Retirement Act income. Part 2 computes the additional Medicare tax that may be due. This is based on the same limitations as you'll see there on line 9, using your self-employment income. However, the one quirk is those limitations are, if you follow the form, reduced by any amounts that you have already taken as Medicare wages. So if you already have Medicare wages, you're filing joint return, and one spouse earned $300,000, the other is self-employed, the self-employment income will all be subject to the 0.9% tax. You'll compute how much is subject to it on line 12, and you'll multiply it by 0.9% here. Due to a quirk in drafting the law, the Railroad Retirement Tax Act compensation is not totally integrated, and especially with self-employment income is not properly integrated. So if I have additional Railroad Retirement Tax Act income, that does not serve to reduce my self-employment amounts before I apply the tax. That means somebody with Railroad Retirement Act wage income could still have a whole nother $200,000 of self-employment income before triggering the 0.9% there. Interesting quirk, not fixed by Congress. That's why Part 3 is down here at the bottom. The additional Medicare tax on Railroad Retirement Act income is computed in this section. The total of the 3 sections is computed on Part 4. This is the number that goes to line 60 of the Form 1040. Now, we're not completely done here yet, though we've computed the tax, but we still have that problem of the withholding. For those who aren't aware, the additional Medicare tax withheld will not have a separate box on the Form W-2. Rather, all Medicare tax withheld, regular and additional from an employee, will be included in Box 6 of Form W-2. What you have to do is figure out how much in excess of the 1.45% of total wages was withheld from your wages. That excess, because you see line 20, you're picking up your total Medicare wages from the top of the form. You multiply that by 1.45% and figure out how much covered the regular Medicare wages, which you won't worry about here. All the rest of it, by the way, even if it's more than 0.9%, because if the employer fouls up and it's not corrected by the end of the year, we still take the excess here now. We pick that up on this particular line. We also pick up our Railroad Retirement Tax Act compensation, the additional Retirement Tax Act compensation, and we take our proper Medicare withholding adjustment and put that on with our federal withholding tax on line 62 of Form 1040. The second tax we have to worry about is the net investment income tax. Form 8960 computes that tax for individuals, estates, and trusts. It is divided into 3 parts. Part 1 computes the investment income, Part 2 computes the expenses, and Part 3 is the computation of the tax. Only in Part 3 do we differentiate between individuals and estates and trusts. More specifically, Part 3 is where the distribution of net investment income by an estate or trust is taken into account. In Part 1, we add up the net investment income. Everybody should be aware it includes interest, dividends. It includes annuities other than those received from a qualified retirement plan. That's why line 3 says annuities from non-qualified plans. Rental real estate, royalties, partnership income, S corporation income, trusts, and actually any business income is potentially subjected to this tax. Only if it represents net income or loss derived in the ordinary course of a trade or business in which the taxpayer actively participates and which is not considered to be a trading business can you subtract that portion out on line B. We'll then get our excess there. That does mean that passive activity income is subject to this tax, as well as most rentals, most royalties, and those sorts of issues. Line 5 does the same thing for gain or loss from the disposition of property. You put that on line 5A, you take out any gain or loss from property that's related to essentially normally one of these businesses that is not considered to be subject to the net investment income tax. And then you figure out if you have any adjustments as well from a disposition of a partnership interest or an S corporation stock. We combine this information down here at the bottom, and then we put as well on line 6 any adjustments that come from controlled foreign corporations or passive foreign investment companies go on line 6. Those, again, the temporary regulations describe that computation. Line 7 allows for other modifications to be made, unusual cases. And line 8 gives us the total investment income. This is before any expenses. Part 2 gives us the allowed investment expenses. This includes investment interest expense on line 9A, as well as line 9B and 9C, state income tax. That is the portion of the state income tax that's allocable to investment income. The temporary regulations describe some methods, or I should say proposed regulations, describe some methods that the IRS suggests can be used to compute this number, as well as in miscellaneous investment expenses. Note, all of these, to the extent they're impacted by it, have to be reduced by any AGI-based limitations. That will include for line C the limitation at the 2% of AGI limitation for miscellaneous itemized deductions in excess of that amount. We deal with those proportionately according to the proposed regulations. As well, both lines B and C are impacted by the return of the P's limitations, the overall limitations on deductible itemized deductions, and we'll have to give both of those lines a haircut based on that. Again, this is described in the proposed regulations. We add up our total deductions. Line 10 allows, again, for special case modifications as allowed by the regulations. And line 11 gives us our deductions. In Part 3, we compute the tax. Line 12 is used for both individuals and for fiduciary returns. That's the net number. For individuals, this is going to be the net investment income. For estates and trusts, we need to make a couple of other adjustments, so we'll move on beyond that. Individuals apply this tax on net investment income or their modified adjusted gross income in excess of the threshold amounts. The threshold amounts are the same numbers here as we saw for the wages, but we don't worry about if we've already had wage income. We simply take those same numbers, $250 for married filing joint, $125 for married filing separate, $200,000 for all other filing statuses, and we compare our modified AGI. The only modification here generally is for the exclusion for foreign earned income, and we subtract those two. And on line 16, we enter the smaller of our modified AGI in excess of those levels, or our net investment income. It's imposed on the lesser of the two, and we multiply that by 3.8%. Take this to line 60 of Form 1040, along with, if we have wage income in excess of limitations, the amount we computed on the 8959. For estates and trusts, a couple of additional things have to be done. First, estates and trusts get deductions for distributions of net investment income and for their exemptions, other sort of basic issues. And so we have to compute what's called undistributed net investment income. That is what the tax is imposed on for the estate or trust if it is in excess of the excess AGI. Well, the AGI, you have to compute the adjusted gross income for an estate or trust under Section 67E of the Internal Revenue Code. And yes, there is a way of doing that, so you need to go back and take a look at that computation. You have to take the highest tax brackets for estate and trust for the year. That's going to be $11,950. This is your threshold amount, much lower than for an individual. You subtract your AGI in excess of that amount, and you take, now again, the greater of, or the lesser of, the net investment income, or your AGI in excess of this threshold amount. And so we end up with that multiplied by 3.8% and carried forward onto the Form 1041. Form 1040, as we mentioned, has been modified some. The draft Form 1040 for this year is out. And if you take a look in the Other Taxes section on page 2, you will see that line 60 now contains boxes for the Form 8959 and the Form 8960. The total of those two taxes, plus any other special line 60 taxes that are added, go on line 60 and are included in your total tax. The Medicare tax withholding will be included down below in line 62 in your federal withholding tax. It will just be an add-on. These are draft forms, and we only have at the moment proposed regulations. This tax is in play for this year, so we're working with both of these. However, we do know that there is going to be modifications and additional guidance coming during the year. For instance, we fully expect that we should eventually get instructions to these forms. We should also expect that we're going to get some guidance in the IRS publications on how to deal with these, especially publication on investment income. And of course, we're going to eventually get the final regulations that will tell us how this works. The IRS has received many comments on the regs, and there is expecting to be at least some modifications that the IRS is already discussing in some areas. Because of this, it's going to be very important to keep up on these developments through the end of the year. That's going to make it very important to be sure that you attend and pay attention to, carefully, tax update courses as we approach the end of the year. We look forward to talking to you during those update courses where the 1411 tax and the excess Medicare add-on tax will be discussed broadly. Again, contact your state society of CPAs for those courses and when they'll be available. But remember, we now are looking at, we have the forms, we have the ability to discuss with the clients, we know some of the basics from the proposed regulations. While this is a complex topic, hopefully this video has helped you to understand the basics of what you need to look at, as well as understand that you should be talking with your clients today about what they can do in the future to deal with these taxes and how you're going to approach these taxes with your clients as we move forward.